This is FRM Part 2, Book 5, Risk Management and Investment Management, and the chapter on predicting fraud by investment managers. This chapter was written by two gentlemen, Dimmock and Gherkin, and these are professors at universities of Kentucky and Singapore. And this was published in a top A-level journal known as the Journal of Financial Economics. And I love it when professionals get to read some really top-level academic journal articles, and this is one of those. Let me just tell you quickly what these two gentlemen did in this article, and I have a couple of slides that'll remind you of this. What they did is they looked at about 14,000 of those Form ADV that the financial advisors have to complete. I'm tempted to tell you guys to go look at this Form ADV. And some of you probably have already completed this, but my gosh, it's over 80 pages, and there are questions on operations, on conflicts. But what's really important for this article is there are questions about disciplinary history. And that's what these two guys have decided to use as input variables to try to predict fraud. I want you to think about this. 14,000 of these, 80 pages long, which included, of course, all sorts of wealth managers, mutual fund managers, and even hedge fund managers. Let's go ahead and quickly look at the learning objectives here. Explain and the use and effectiveness of information. All right, discuss barriers, and then how about ways to predict that fraud? And so the underlying objective here in these three specific objectives is fraud. We know it exists. How can we identify it? And then how can we avoid it? All right, investment fraud. Here's a really good definition. I'm guessing this is not new for any of you. Wide range of deceptive practices used by managers to get money from unsuspecting investors. Wealth managers may use false or deeply misleading information to convince the investor to do something that he or she normally wouldn't do under reasonable conditions. How about 4 general signs of investment fraud? Let's suppose I'm the wealth manager and I come to you and I say, hey, I'm really smart. And I promise that I can generate 10%, 20%, 30%, pick a number. Extremely high rate of return. Maybe I could even guarantee it. And then I follow that up with, hey, you know what? On top of being super smart, I can get you these high returns and I can take only this much risk. And then, of course, high pressure, oppressive tactics to convince the investor like, hey, I got this information, and boy, the public is going to learn of this information in 7 minutes, and so you better make up your mind here in the relatively near future. Here's a huge area of fraud: is that you may think that the wealth manager with whom you're dealing is some kind of a professional, right? But a lot of these individuals may not even be registered. And then the fourth one there, that's a little piggyback on what I said with the high pressure. Hey, I might have inside information. Like, look, I was at lunch the other day and I overheard such and such, and it's only good for a short time period. But notice that there are some common forms of this fraud. I'm sure you've heard of these: pump and dump schemes, pre-IPO investment schemes, Ponzi schemes. We'll talk about Bernie Madoff here in the next slide. Pyramid schemes, and there are all sorts of stuff going on. Pump and dump, that's been around for a long time. I'm guessing that if you do a little bit of a history search, you can go back, it's been 300 years by now, to Holland and the tulip bulb mania. Pump and dump. I'm sure they didn't call it that back then, but clearly they bid up the price of these tulip bulbs so that only super wealthy people could afford them. Now, of course, we spent some good time talking about the 2008 financial crisis. We also spent some time going back to things that happened at the turn of the century. And so, let's go back, a couple of decades here. We know that the SEC has intensified efforts to uncover fraud. However, remember, the government does some things really, really well, and they do some things with less than the efficiency that you get inside of the marketplace. So even though the SEC has intensified these efforts, it's probably not going to uncover all of the fraud. But I do like that second circle point there. Strong pursuit of insider trading claims. Boy, if you read the Wall Street Journal regularly, you'll read about this. High whistleblower payouts. Of course, that's way more common these days than it was, 15 or 20 years ago. And then scrutiny of all asset valuation methodologies. Of course, we love things like the capital asset pricing model. We love the Black-Scholes-Merton option pricing model. But, if you come across a wealth manager who says, hey, I'm using Jim's futures contract pricing model, you ought to scratch your head and say, well, I think I remember Jim, but maybe he doesn't have a great idea about futures prices. So look at that second point there. Are investors out of the woods yet? Of course, no. Let's do a no with an exclamation point. You remember when Kramer and Seinfeld did the exclamation point? That's what I thought of when I was reading this article. No, fraud still remains a gigantic problem. In fact, the more government regulations and rules, then the fraudsters out there are going to be more innovative, more financial engineering minded, and of course, finding ways to maneuver in and out of the reaches of the law. So here's the case of Bernie Madoff, charged with securities fraud. He admitted to what was essentially a Ponzi scheme. And I have a couple of pieces of data down here. Look at this down at the bottom teardrop point. How big was the fraud? Estimated around $65 billion. And I think that was pretty much what the paper losses would have been according to Madoff's records. I think the SEC has come up with a different figure, around $20 billion of actual losses for clients. I mean, I'm not discounting and saying, oh, it was only 20 billion. I'm saying, some of those may or may not have been realized, but look at this. Madoff's 4,800 clients, and they scrutinized all these clients. And the saddest thing about this Ponzi scheme, and I'm guessing you don't need a little bit of a review of that, but of course Madoff promised these high rates of return, and people who were early on, they probably got a high rate of return. But then the other investors who came on subsequently, they probably were not. And this thing worked as long as new investors were willing to invest. And Madoff had this tremendous network of colleagues and friends and acquaintances and recommendations so that he could continue to do this for quite some time. But the saddest thing for me, not only as an investor, but as an ethical human being, is that, some of his clients were really famous people and really famous institutions like Royal Bank of Scotland and the Royal Bank of Canada, the Los Angeles Jewish Community Fund, and some of his individual investors included, famous people like Sandy Koufax and Steven Spielberg and Kevin Bacon. So for me, the saddest part of this was, the connection with religion to convince people that he was trustworthy. All right, so Madoff sentenced to a long, long time in prison. In the years following that, there was a concerted effort by both lawmakers. I mean, of course, this made it to Congress in Washington, and also those individuals and institutions inside of this industry to go ahead and say, you know what, we need to make certain that this doesn't happen again. So look at the third teardrop point. SEC has responded by proposing all of these regulatory changes. But notice what I have in red down there. Of course, we're responding. The SEC responds to the specific areas that Madoff exploited, but they barely mention disclosure. And that's one of the great parts of this article. So notice down at the bottom, disclosure is paramount. And so we're going to go back to that form ADV here in just a few minutes. All right, what is disclosure? Timely release of all information that could reasonably, those of you who watched my recordings will know that I love that word reasonably be expected to influence an investor's decision. Of course, we want timely information as investors of both good news and bad news. One of the great things about the human element is that we're very willing to forgive mistakes, right? As long as we know about them, but we're not willing to forgive mistakes if they're covered up. So if a wealth manager makes a mistake and you end up losing, let's say 10%, and everybody else gained 5%, if the wealth manager comes and says, hey, I did this and this, these were my reasons, I did this, and I didn't do as well as a steward of your capital as I had promised, well, we can probably let that pass as long as timely information, et cetera, et cetera. But we also say things like, we'll give you one mistake, but we probably won't give you a second. And clearly we don't want to go all the way down the line. All right, so what did I tell you? This form ADV has thousands and thousands of pages. I think it's 83 pages. So there's a couple of parts. Part one, just information. And you go through this thing, it asks you, what do your assets look like? What do your clients look like? So business practices, ownership, clients, employees, and all sorts of affiliations. And then part two is about compensation and business practices. And so there's fees in there and conflicts of interest. So that's really important. Then part three, the types of services offered, and then the fees and the costs paid by the clients. And then somewhere towards the end, there is a section on, all right, have you ever been arrested before? And of course, that's a general question, but have you ever done this and this and this? Have you ever come before a board or a legal body? All right, so here's what these two researchers did. Look at this, 13,853 advisors, $32 trillion in assets. So they did this through a 5-year period in the early 2000s. So look at that last sentence there under the lowercase I. Form ADV contains information on conflicts of interest as well as past regulatory and legal violations. All right, so then these researchers scrutinized the SEC files for almost a 10-year period in which there was fraud. And then they put together some kind of statistical test to say, all right, is there stuff in the ADV that can predict what occurred in the SEC files? And look at my light red box down there that research revealed that disclosures, all right, there's that word again from the previous slide, related to past regulatory violations, conflicts of interest, or some kind of monitoring, all significantly predict fraud. What this tells us is that if there are wealth managers out there who are finding ways to cut corners and then finding ways to change their behavior so that they're not detected by the law. And then there are wealth managers who are actually breaking the law. So if you go through that whole spectrum and they report this on the ADV, then they're going to do it again. And so there's the model. The basic of this model is that if you cut corners, if you cheat, if you plagiarize, if you commit fraud, if you defraud in minor issues, then it's probably going to continue throughout the coming years. So what does this say? If an investor avoids 5% of the firms with the highest ex-ante fraud risk, now that fraud risk then was measured in those ADV filings, then they're able to avoid, boy, look at that, about 30% of fraud cases and about 40% of the dollar losses from fraud. So this is a tremendous amount of information. And one of the cool things about this article is that the authors suggest that there's been very little research done this on the past. So it took these two really smart guys to come up with this idea, and look at what they have provided for us. There's a wealth of information. So here's one of those learning objectives. Which variables show significant ability to predict fraud? This sounds to me like a great exam question. All right, so disclosures on past regulatory violations. So look at that first diamond point. Statistically significant fraud prediction power. And so here's what I was saying earlier. Look, past problems, even if only minor. So tiny infractions early on probably lead to major infractions later on. So look at the explanation. Indicative of long-term, deeply entrenched issues, whether it's unethical behavior or poor internal controls or some other method. Referral fee shows a significant positive relation to future fraud. And this makes some sense, right? If we're more willing to pay a referral fee, then we're probably more willing to commit fraud. How about this one? An investment manager who takes the opposite side simply cannot be trusted. So having an economic interest in those client transactions. Let me go back to an example that I've used before, and I'll do it very quickly here. Do you remember in that great movie, Trading Places, Mortimer and Randolph Duke were saying to Eddie Murphy, they're saying, look, when our clients bet that the price of orange juice goes up, we win. If they bet the price of orange juice goes down, we win. Now they're acting as brokers in there, and I'm not suggesting that Duke and Duke Securities in the fictional movie were committing some kind of fraud, although they do commit lots of crimes in that movie. But here's just an example of having an economic interest. And then some other variables here. Firms with dealer brokers as affiliates, of course, this removes independence and allows bias. It removes the external oversight. Account size, that makes sense. Larger investors are associated with fewer frauds, mostly because larger investors, like if you have a $12 million portfolio, you're probably going to pay a little bit more attention to what's going on. And so the wealth managers are less likely to commit fraud in that particular account because it's probably more likely to be detected. And then how about this last one here? Firms whose clients include a high proportion of agents like pension fund managers acting on behalf of employees are probably more likely to commit fraud. That makes sense. Soft dollars, I love this one here. Soft dollars, here's the example that I give my students. Suppose I go through some firm and I buy $100,000 worth of stock. And let me just round up for just simplicity, mathematical purposes. Suppose I'm charged some kind of a fee or of commission of $1,000. And so I expect that $1,000 to go to things like, maybe paying the wealth manager's salary, right? Maybe paying for their internet access, maybe paying for some advertising. But I'm also aware that it might go to something else, so that wealth manager might take my $1,000 and buy some research from another firm over there. All right, now we're getting into these soft dollars. So now that research firm may provide some research reports, but because that research firm over there is in competition, maybe there'll be a discount there. Maybe that person will say, hey, you know what? I have this Monet painting in my basement that I'm not using. Do you want to hang it in your office so that you can attract clients? So now we need to start scratching our head about these soft dollars. What's going in there, like kind of a non-cash transaction. How is that influencing the performance of my portfolio? Right, my $100,000 portfolio, I paid $1,000. I'm perfectly willing and happy to pay for the wealth manager's salary or his commission or her commission. But boy, what do I, like if that research firm is paying the wealth manager's mortgage because of that relationship, then I probably don't want that. Custody, I thought this was interesting. Taking custody of a client's securities does not significantly increase the probability of fraud. I would have thought maybe that was true going into the model, but then I would have been wrong. How about some barriers in implementing these fraud prediction models? I mean, these are really things that I had no idea before I read these. Look at the second Diamond point. Research strongly suggests that a prediction model that relies on all prior Form ADV filings performs better than a model that only relies on a cross-section. All right, so what you need to do is make sure that you don't, when you cross-section these, that you get, what is that, 26% of frauds compared to panel data of just about 31%. So this is a substantial difference. And so that's important to remember that although the SEC discloses each investment firm's current ADV, you may not have access to that historical filings. So the point of this one, absence of historical form, this is an incomplete data set. And then I thought this one was really interesting. I mean, based on the format, like we're used to just clicking on our phone or on our laptop and, we get this stuff and it's in the form that we can read. But historically, look at the circle point. These filings were shared as HTML documents. And so, you get an HTML document and depending on what kind of software you have on your computer or your phone, you may not be able to read it. So look at the second purple bullet point. This scared off some investors who had no idea how to go about the extraction process of the format of the data. So what do we have in part one back here? We had incomplete data, and here we have data that is no use for us. So notice the bottom point there, 2008, provision of historical form ADV data in a standardized format, which means that you and I can go out and use this data for something that is meaningful. And that takes us through just our 3 learning objectives, but I think they're super, super fun to read about and much more interesting and captivating than some of the math that we've been doing, even though I love math and I know you guys love math. I would say that, all 3 of these are pretty good questions to ask on the exam. Although I do like, let me just swing back here. I do like this one here. If I'm a test creator, which variable shows significant ability? I think knowing these is probably a higher probability on the exam than rather, just kind of a question about Bernie Madoff.